all, good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on cement, short-term headwinds turning into long-term opportunities. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Dharmender Tuteja, Chief Financial Officer at Dalmia Bharat Limited and Dalmia Cement Limited. Mr. Aditya Saraogi, Group Chief Financial Officer at Birla Corporation Limited. Mr. Jigar Shah, Chief Financial Officer at Wonder Cement Limited. This session will be moderated by Sabyasachi Mazumdar, Senior Director at CareEdge Ratings. We will commence the session with a presentation by Bhoomika Sharma, Analyst at CareEdge Ratings, and Yash Gupta, Assistant Director at CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of this discussion. Now, may I invite Bhoomika to make the presentation.
Good evening, everyone. The cement sector has encountered several headwinds recently, collectively contributing to subdued offtake during the first half of the fiscal year. Despite these challenges, the sector's outlook remains optimistic. The long-term demand remains robust. Pricing continues to lag as companies prioritize volume growth and market share in an increasingly competitive landscape. To set the context for the flow of presentation today, the key discussion will be around cement demand and underlying factors that shall drive the same, the supply side dynamics and the interplay of consolidation. After briefly touching upon the pan-India utilization levels, we shall move to the cost and price side of the industry. And we will then talk about the trajectory of operating margins and per ton profitability in the industry and how the credit profile is expected to remain. Now, let us have a closer look on each of these. Herein, we are talking about the demand trend. In Exhibit 1, the blue bars are the total cement demand and the blue line is the year-on-year demand growth. Green line is the GDP growth rate. We have tried to segregate this period into different phases since FY15. The period from FY22 to FY24 has seen exceptional growth in cement demand, culminating in a 9% increase in FY24. This is primarily driven by a pickup in housing, pre-election, and thrust for infrastructure. Moving into FY25, we expect demand growth moderation due to the high base effect and softer demand observed so far. Historically, spending and demand tend to rise significantly in the 2 years leading up to a general election, followed by a cooling off period in the year after. As seen in the first half of the fiscal, the cement demand has been relatively stagnant across the industry. This was influenced by the impact of general elections, extended monsoon season, and the sluggishness in infrastructural activities. In the months of October and November, cement demand growth was influenced by the festive season and the current construction ban in the northern region. We anticipate that demand will begin to rise starting in December and to achieve a full year 4 to 5% growth in demand, which is a noticeable slowdown against the previous years. It is essential for government spending to increase over the next 4 months. Nevertheless, given the mandatory nature of infrastructure spending, we expect significant growth momentum to resume by FY26 with a stronger pace of development. For FY25, CareEdge Ratings projects a GDP growth rate between 6.5 to 7% with an anticipated cement demand to GDP multiplier of 0.7x. This ratio is expected to return to 1x as we move forward and demand gains momentum. From a long-term perspective, we project the compound annual growth rate for cement demand to range between 6.8 to 7.2 or 7.5% over FY25 to FY30 period. Herein, we have depicted the key cement demand drivers across sectors. Approximately 55 to 60% of the total cement demand comes from the housing sector, while infrastructure contributes around 30% and the remainder comes from the industrial segment. This distribution, however, has evolved over time. Previously, housing accounted for over 65% of demand, while infrastructure share has grown from 25% to the current 30%. We anticipate that this share will further increase to 33 to 34% in the coming years due to the government's strong infra push and increased budget allocations. While FY25 is seeing slower growth and subdued government spending, we maintain a long-term outlook aligned with India's broader growth strategy, with housing continuing to be primary driver of cement demand, also the bedrock of the industry. Having talked about overall demand drivers and their share in total demand, we will walk you through few updates on real estate and infra side. Here in Exhibit 3, we have new supply, annual sales, and unsold inventory data over the previous years in the residential real estate landscape. CareEdge Ratings forecast that both sales and launches will continue to remain robust, supported by urbanization, rising income levels, and significant infrastructure development across the country. Additionally, central and state government-backed infrastructure projects are significantly enhancing connectivity and accessibility, leading to emergence of new real estate development zones. Government initiatives such as RERA, Pradhan Mantri Awas Yojana, and the Special Window for Affordable and Mid-Income Housing Fund have improved supply and affordability, boosting demand. As illustrated in Exhibit 4, the government's housing programs show that approximately 5 million houses in rural areas and 3 million houses in urban areas are still pending as of November 2024 from the previous announcements. Furthermore, under the Grameen scheme, additional 20 million houses have been planned, bringing the total target to 49.5 million over the next 5 years, out of which 32.1 million have already been sanctioned. This continued development is poised to maintain momentum for cement demand from housing segment moving forward. Now let's look at the infra side. Infrastructure is set to expand its share over the next 5 years, driven by the government's focus on flagship schemes like PM Gati Shakti and increased investments in roads, railways, metros, airports, and irrigation. Herein, the roads are expected to see the highest traction. The set target under Phase 1 of Bharatmala project is 34,800 kilometers, out of which, up till March 31st, 2024, only 50% has been achieved, indicating that larger part of demand is expected to materialize in the second half of the fiscal and in FY25 and 26. Given the pace of execution in the last two fiscals, the target completion date has also been extended to 2028. Herein, in the bottom half of the slide, there is an update given in each of the key sectors which contribute to cement demand from the infra side. Coming to the metro works, in Exhibit 6, which is at the bottom right, we have shown region-wise approved, under construction, and upcoming routes to understand which region may see higher demand from this segment. Going forward, the increase in infra outlay is expected to have a multiplier effect across sectors and set a strong footing for growth and shall keep supporting volumes in cement sector as well. As the sector exhibits regional nuances, here we have summarized the demand drivers by region and end user category. The dark green arrows indicate high demand, while the light green arrows represents moderate demand. Over the FY20 and 24 period, the eastern region, followed by the central region, experienced robust demand growth. We project growth at a slightly higher rates for these regions, as both of these regions have lower per capita income and cement consumption compared to the national average, offering room for growth. Especially the eastern region is expected to continue leading demand growth, fueled by the ongoing rural housing project and the relatively low base of infrastructure development. The northern and southern regions are also anticipated to see strong growth supported by various infra and housing projects. While in contrast, the western region might see a slight moderation in growth due to its already high base from the past two fiscal years. Although it has numerous major infra projects underway, its high per capita cement consumption could limit additional growth potential. Now let's take a closer look at the supply dynamics of the industry. We will begin by examining the pan-India capacity and utilization levels, followed by a detailed analysis of regional utilization and upcoming capacity additions. Here in Exhibit 8, the blue bars illustrate industry grinding capacity over the years. The green line represents the demand growth rate, and the dark blue line above indicates capacity utilization rates. The positive medium-term demand outlook and a push to capture greater market share have spurred a wave of capacity announcements by cement manufacturers, particularly among larger players. Approximately 80 metric ton of new capacity is expected to become online by mid-FY26, with plans to increase the total capacity by 140 to 150 metric tons by FY28 to FY30. Large companies are expected to contribute the bulk of these additions due to their stronger financial positions, enabling them to navigate challenging periods. CareEdge Ratings expect demand to back up the upcoming capacities. Hence, no significant decline in the utilization levels is projected, and it is expected to hover around 68 to 69% at industry levels over the next 2 to 3 years. Further, the sizable capacity additions will limit a further rise in operating rates, and hence the pace of expansion and demand matching up will be a key monitorable that would determine any intermittent demand and supply imbalances. Now, having looked at pan-India utilization and capacities, we are now moving to regional utilization levels. This slide highlights region-wise capacities expected to be added over the next 2 fiscals. Exhibit 10 provides a brief overview of region-wise demand and supply CAGRs, while Exhibit 9 depicts the projected impact of these changes on utilization rates. In the northern region, capacity utilization is expected to decline slightly due to the lower growth projected for FY25 and the recent addition of supply in FY24. However, by FY26, this is anticipated to recover. The lowest utilization is observed in the southern region due to a significant gap between the capacity and production. This fiscal, a slight moderation of 100 basis points is expected, while in the medium term, the utilization level is likely to remain stable due to balanced supply and demand dynamics, and no significant increases anticipated due to the upcoming supply. In the West, utilization inched up due to healthy demand. Also, CAGR of the upcoming supply is lower than expected in demand. Hence, utilization will remain same or will marginally inch up by the next year. The eastern and central regions are expected to see stronger demand growth, which will support the corresponding capacity expansions, and hence the utilization levels will remain range-bound as seen. In the bottom half of the slide, we have shown region-wise capacity additions, with the south and east regions leading, accounting for nearly 55% of the total capacity coming online. The healthy demand outlook in the eastern region is a key driver for these additions, while in the south, infrastructure growth and abundant limestone reserves are the primary factors fueling the expansion. Moving on, now let's examine sector consolidation. This slide highlights the market share trends of the top 5 players in each region from FY22 to the projected FY26. North remains the most consolidated, with balanced capacities being added by all the key players, while in contrast, South has been the most fragmented region, but recent merger and acquisition deals announced will improve the consolidation by top players by FY26 end, but it remains the most fragmented market still. In the East, all the large major players have their capacities spread across in the key markets, while regional players command lower capacities. West is dominated by the top 2 players commanding over 55% market share, with steady organic growth keeping the region highly consolidated. And in the central, new entrants have joined the top 5 with limited capacity additions from regional players. This region is expected to maintain consolidation at 60 to 65% by FY26. Going forward, majorly we expect more consolidation in the southern region. Now, in this slide, we illustrate the share in cement demand within the sector by the top players. In Exhibit 12, the industry volume sold is divided between the current top 4 players shown in blue and the next 5 to 9 players shown in turquoise. The top 9 players now account for nearly 80% of the total cement demand, out of which the top 4 players contribute to about 58 to 60% of the industry demand, reflecting their strong market hold. By FY26, these 9 players are expected to meet nearly 90% of the total cement demand, underscoring the continued consolidation in the sector. Moving forward, let's take a comprehensive look at the competitiveness within the industry. Here in Exhibit 13, we highlight the sector's consolidation trends, showing the performance of the current top 4 cement players in FY12, their status in FY24, and the projections for FY26. The capacity distribution is segmented among the top 4 players, and the players ranked 5th to 25th, and those beyond the top 25. As shown, the largest 4 cement players had a consolidated market share of 35% capacity-wise in FY12, which has strengthened to 50% in FY24, and it is likely to be around 60% by FY26 end. 40% of this capacity share gains till FY24 came from mergers and acquisitions and inorganic expansion, largely of distressed assets. Inversely, the capacity market share of moderate sized cement players, that is between 5th largest and 25th largest, reduced from 46% in FY12 to 39% in FY24, while the rest of the cement players' capacity market share dipped from 19% in FY12 to 11% in FY24. We believe that the merger and acquisition activities for nearly 60 million tons of cement capacities may happen over the medium term, out of which announcements for close to 45 million tons are of public knowledge, thus continuing the trend of consolidation. Now, I would like to hand over to Yash, who will take you through the cost and price elements as well as the financial and credit profiles of the players.
Thank you, Bhoomika. So let's come to the cost part of producing cement. Herein, all the key cost parameters are shown as a percentage of total cost over the years, as provided in Exhibit 15. The raw material cost as a percentage of total cost ranged between 16 to 19%, freight and packaging between 30 to 34%. Power and fuel cost, which used to be in the range of 25 to 27%, significantly spiked to 35% in FY23 on the back of Russia-Ukraine war, and now stood at 31% in FY24, owing to some cool-off in petcoke and coal prices. With further expectation of softening in prices in FY25, this cost may reduce even further. Basically, fuel consists of coal and petcoke for heating the kilns. Power to run the kilns and cement plants is majorly made through thermal power. However, the industry is slowly inching more towards greener energy to not only reduce the carbon emissions, but also reduce the power cost. Going forward, it is expected that the average total cost will hover around 4,400 to 4,500 per ton, contracting from the recent past couple of years, however higher compared to pre-FY22, as the new normalcy seems to have set in, as we will observe in the next slide. Power and fuel cost per trend can be seen in Exhibit 17. During FY24, the petcoke and coal prices have largely normalized, owing to relatively better demand and supply dynamics in terms of fuel and ebbing of the initial shocks from the geopolitical crisis. We are seeing continued moderation in fuel costs in P&L starting from Q2 or Q3 FY24. Looking ahead, fuel costs are expected to moderate in FY25, subject to continued decline in the fuel price and higher base effect. Geopolitical events will continue to cause price volatility. While crude oil prices eased in FY24, the limited pass-through by the OMCs in India kept the freight cost per ton at elevated levels, as observed in Exhibit 18. In FY25, this cost is expected to remain muted or see marginal increase, while any reduction will be subject to revision in the diesel prices nationally. Now, coming to the realization part, you can see net sales realization trends, which is depicted in Exhibit 19. Post the continuous incremental rise over the years till FY23, FY24 saw deceleration after a long time in the NSRs. FY24 registered flat prices with negative bias kicking in from March 2024 onwards. Demand in March 2024 was muted, which continued in H1 FY25 on account of the parliamentary elections, portfolio allocations post-elections. Along with that, erratic weather like scorching heat witnessed in some regions in Q1 FY25, and post that excessive rainfall hampered demand and prices further. As per India Meteorological Department, the country has recorded 8% above long period average rainfall between June to September 24. This created challenges for the consumption of cement more severely in areas where the rains were in excess, leading to further lower volume of take and pressure in realizations. We have seen NSRs in H1 FY25 dropping significantly, as much as 6% year on year on an average, with some regions seeing much worse. However, vice versa, we expect better rainfall to lead into better agricultural prospects in near term, which may boost rural demand. Hence, performance in Q4 FY25 will be critical. The price hikes have been announced in September. Sustainability of the same will be based on how demand fares. Currently, CareEdge predicts 3% cut in overall realizations in FY25 against FY24 with some uptick expected in FY26. Any supply-demand mismatch in the industry and resultant effect of the same on the prices shall remain monitorable over next 2 years. Coming to ROCEs and PBIT per ton, as seen in Exhibit 20, PBIT per ton is estimated to hover around rupees 850 to 890 per ton in FY25 due to pressure on realization. This takes into account expectation of turnaround in prices and volume growth in H2 FY25, particularly starting from December. Any deviation in the same may lead to further deterioration. Accordingly, we expect to see moderation in ROCE in FY25 as well. Capacity utilization is expected to remain around 68% to 69% in FY25. Exhibit 22 represents net debt to EBITDA range across top 3 rating bands, AAA, AA, and A category over the years. As you can observe, the range of net debt to EBITDA of AAA band players is largely better compared to AA band players, and AA band players is better compared to A band players. Net debt to EBITDA generally trended downwards across all rating bands over the period in, as you can see. However, in FY23, it was impacted because of the sharp rise in the fuel cost, leading to impact in EBITDA. In FY25, these metrics are expected to see some moderation as players take on additional debt on their balance sheets to support both organic and inorganic growth plans amidst industry consolidation, along with moderation in profitability. CareEdge rates close to 53% industry capacity across large, mid, and small-sized players. Being a consolidated industry with long-standing and entrenched players, a significant 43% of the rated portfolio is in the AA and AAA category. Now, having talked about the industry dynamics and credit profile of the players, we'll now summarize key takeaway points. Credit profile of the players should remain largely stable, owing to strong balance sheet, enabling them to carry out capex, particularly by large players with continued sector consolidation on the cards. Though the demand growth has moderated, capacity additions is supported by the long-term India growth story. ESG and cost reductions will also be key focus. Key monitorables will be fuel costs, ability to undertake sustainable price hikes, and cement demand and supply mismatch, all leading to how profitability pans out. Over the long term, we will continue to monitor changes in MMDR Act. With this, we come to the end of our presentation. Thank you, everyone. I now hand over to Ms. Mamta to take the session forward.
Thank you, Yash and Bhoomika. Attendees are requested to key in their question, which we will take up after our panel discussion. Now, may I invite Sabyasachi Mazumdar to take over the session, please. Sabyasachi Mazumdar is a Senior Director, Ratings at CareEdge. He has over 25 years of experience in credit rating and sectoral research across diverse sectors, such as power, renewable energy, cement, sugar, chemicals, oil and gas, etc. He is an alumnus of IIM Lucknow and Delhi College of Engineering. Over to you, Sabyasachi.
Yeah, thank you, Mamta, and welcome to everyone to our webinar on the cement sector. And first of all, thanks to Yash and Bhoomika for putting up such a good presentation, which sets the context very well. And I would also like to now introduce the 3 distinguished panelists who have taken their valuable time out for gracing our event. Our first participant in our panel, Mr. Dharmender Tuteja, is the CFO of Dalmia Bharat and Dalmia Cement Bharat Limited. He's the CFO of the group, and he has been working with the Dalmia Group for the last 10 years and has held leadership positions in finance and commercial functions. Before joining Dalmia Group, he has been with several other very reputed companies such as KHD, Samtel, Control and Switchgear Group, Crypco, and Sale. And he has a total work experience of over 34 years. He's a member of the Institute of Cost and Management Accountants of India and Institute of Company Secretaries of India, and is an alumnus of SRCC. Good afternoon, Mr. Tuteja, and welcome to our panel.
Thank you.
Yeah, our next panelist, Mr. Aditya Saraogi, he's the Group CFO of the Birla Corporation Limited. He's a chartered accountant with more than 36 years of diverse experience across various parts of the finance function. And prior to joining Birla Corp, he was with Ernst & Young, as well as and handled several large clients such as ITC, Bharti Airtel, Lafarge India, PLS, etc. And is responsible for the financial oversight of the company and its subsidiaries, acquisition, M&A activities, and he has also played a key role in the integration of operations of RCCPL Private Limited, a major subsidiary of the company. Good afternoon to you, Mr. Saraogi, and welcome to our panel.
Thank you, Mr. Mazumdar.
Yeah. Our final participant today in our panel is Mr. Jigar Shah, CFO of Wonder Cement Limited. He has over 18 years of experience in the field of finance and strategy. And prior to Wonder Cement, he has also worked with other major groups such as Vedanta and Kalpataru Group. And he has a wealth of experience in the manufacturing and EPC sectors. He's a chartered accountant with a BCom degree from the HL College of Commerce at Ahmedabad. And he's also loves to travel and play cricket. Welcome, welcome aboard, Mr. Shah.
Thank you.
Yeah. So without further ado, I would like to get straight into the discussion, and time permitting, we'll also try to take a few questions from the audience as well. So my first, question to all the panelists pertain to basically demand and how they see the market going forward. My first question to you, Mr. Saraogi, what do you see? I mean, 25 more or less have got a very good sense of what 25 is going to be, because we are practically towards the fag end of the year. So how do you see the growth panning out for FY 2026, and how do you see the demand building from now, since the elections and monsoons and everything are now done? And which region do you see higher demand growth, and which regions do you expect to see challenges in terms of demand?
This question is for me?
Yeah, Mr. Saraogi, for you.
Okay. So we have seen that the first half of the year, the demand was quite muted. In the first quarter, it was affected by the election and the heat wave. And in the second quarter, it was mostly the monsoon. Now, largely the expectation is that the second half of the year will be much better in terms of demand. And we expect for the year as a whole, the demand to be in the range of 6 to 8%, the growth. And in terms of region, I would say currently we are experiencing that East is relatively better, and West is lagging because of election. And North and Central are slightly subdued on a relative basis.
Okay. And what would be the reason why they would be slightly subdued right now?
See, there are a couple of reasons. One, we find that the government spending is not happening the way it should. That is one. And secondly, there is a shortage of labor. Usually you find that the labor come back after Diwali and Chhath. Now, for some reason, maybe because of harvesting, primarily because of harvesting, there's a labor shortage which we are experiencing, which is affecting the demand currently, but it is expected that from December it should pick up meaningfully.
So let's say if I was to put a number for, let's say, some exact number, or let's say some range for FY25 based on current trend, and also for, let's say, FY26, any numbers on an all India basis that you'd like to hazard?
See, FY25, the growth should be low single digits. That would be my sense. FY26, I expect that the growth to be much better. There should be some catch-up effect also. So I would expect that to be in high single digit.
Okay.
Yeah.
So I would just like to, have, Mr. Tuteja's views on this. How do you see the demand growth coming? Where do you see the demand growth coming from? I mean, do you agree broadly with Mr. Saraogi's number? And where is the demand going to come from? Is it going to come from real estate and infrastructure projects, or is it going to come mainly from the rural housing or urban housing? So where do you see the demand coming from, Mr. Tuteja?
Okay, before I answer this question, first of all, heartiest congratulations on a very comprehensive and very concise presentation done by CARE, and entire team has done greatly well. All the key aspects of the industry here captured very succinctly. So coming to your question, in fact, if we see last 2-3 years, we have seen that all cylinders of the economy, especially the housing as well as government spending, industrial or commercial segment, all segments have been firing. So only the first half has seen muted growth because of the elections as well as the above average rainfall. And these aspects, I think, should normalize, because it's very natural that whenever the government changes, state government spending also goes down. The new government starts reviewing the projects awarded. So a couple of states, we saw the changeover of the government. So those effects will be still there. But very soon, I think these will come back. The spending, as Mr. Saraogi also told, that government spending was much lower in the first half. I think hardly about 37% of the annual outlay they have spent. So that has to now jack up. That will also push demand. And since the launches and housing, etc., they have all been very good in the last couple of years. So I expect that that should also come back. So for the current year, I expect that second half we should see about 8% growth. First half is hardly about 2% or so. So full year average, I expect up to be about 6% for the current year. And in the coming years, 2-3 years, I think it should go back to now 8 to 9%, considering the Indian economy growth of about 6.5% or 7%. Because
so basically, Mr. Tuteja, we need not write off FY25 as a very bad year. Still, there's a lot of juice ahead in the remaining 4 months.
That is my view, yes.
No, that's very encouraging to hear, because there has been a lot of, gloomy news from the sector. And specifically, just 1 or 2 points, to the specific, because your group is quite strongly, present in the southern and eastern regions. And obviously, there are a lot of infrastructure projects in the eastern region and south, particularly, with Andhra Pradesh, likely to go whole hog ahead for the, construction of a new capital, and, particularly the eastern region is short on infrastructure. So how do you see, that play working out over the next couple of years?
Yeah, that demand should come back. In fact, when the budget was announced, Bihar and Andhra were, I think, all over the budget documents. So huge push will be there. And considering that, there is also now capacity launches also happening in these 2 areas. The capacity growth from the leading players in in these regions are more than what you see for the rest of the regions. I think close to about 8% CAGR capacity growth is coming both in east and south. And so competitive intensity also is going to be highest in these 2 regions compared to the rest of the regions. So that's definitely, so competitive intensity challenges will be there. But I still expect, demand should be growing 8 to 9% in these regions. So capacity utilization may not significantly improve.
So the same question to you, Mr. Shah. I mean, I see a lot of, optimism both from Mr. Saraogi as well as Mr. Tuteja. So do you also broadly see the, share the same optimism about demand and where it's going to come from? And also, since you are quite strong in the northern and western region, we'd like to have a regional flavor from you, as to how north and west are going to pan out over the next couple of years.
Sure, Mr. Mazumdar. So thank you, entire team, first of all, for arranging this webinar. So it is not up to that what easy it looks like. See, Pan India, while saying that it's almost 7 months is completed, 7.5 months is completed in this financial year. And now, while speaking, the growth is almost flattish, or say only couple of percent growth YOY compared to last financial year. And last 3 years was fantastic for the cement industry. Post-COVID, that is obviously pent-up demand, say 20-22% growth, and then both the years 9% growth year on year consecutively. So this year on the strong back foot, that strong foot, that the demand will continue to rise at say 7 to 8% when we started the year. However, unfortunately, first 7 months, the demand growth is hardly anything. It's 1 to 2% kind of a thing. And to achieve with that vision of what Mr. Tuteja has mentioned and Mr. Saraogi has also mentioned that say around 6% growth for the full year, that means a huge task for the balance 4.5 months, which is left out. And while seeing the demand, which is actually coming from the ground across all the segments, whether it's infrastructure, rural, urban, or real estate, these signs are not so positive as of now. So basically, the question comes that to achieve the 5 to 6% growth, I have little apprehension. I say that even we'll touch 5% YOY for the full financial year, that will be a big thing for the sector, and that will give a good 4 5 months from now onwards. So that I have little apprehension that whether we'll able to clock more than 5% for this financial year. But we all are hopeful that demand will come up, particularly for these last 4 months from December onwards. So that is on the demand side. Particularly that the demand itself is not there. And this is what the reason we all know that general election followed by extensive rainfall and followed by the festival seasons also. So now the demand will come up largely that what we are anticipating that demand will come up through the real estate segment first, followed by the infrastructure. That government spending in the infrastructure has to push up, and that only give the support to the industry in terms of the demand growth. And once the demand will come, everything will fall in line that what the problem industry is facing. So we all are hopeful, but my takeaway is that 5% for the financial year itself is a big number for this year.
Okay. So broadly, as I see it, I think I see that all the three panelists are quite optimistic about the long term. But Mr. Shah is slightly, cautious about the current year. But it seems that the long-term growth drivers remains intact. So, the next question then logically we move to is, towards capacity and capex, because obviously, the capacity and capex would be driven, by the demand. Now, what we understand is that there's all the major groups which are there, they have large, capex plans. But how do we stay as, in light of the slowdown in demand in this year, and given the fact that the capacity utilization perhaps has been a bit lower than, what would have been anticipated at the start of the year. So how do we see the, capacity expansion story panning out? So I begin, with Mr. Shah again this time. Mr. Shah, if you can, share your perspective on, how you see the capacity panning out.
See, capacity which was announced and which is currently under progress in project stage, that will continue to come up. That the current subdued demand, particularly for this short period of last 6 months, will not impact any growth aspect for the industry, and particularly for the projects which are currently under construction. However, if this span will continue, say for another, say this which is most optimistic period of next 4 5 months, and if this subdued demand will continue, it will have an impact on the new expansion which will be announced by all the players, not only about the big or small players, but across industry. It will have an impact on the further expansion projects which is not announced or which is not commenced yet. But for the ongoing projects, definitely, which is likely to come in FY25-26 or say by early FY27, that will continue on its track, and that will be operational as per the projected timeline.
Yeah. So what would those numbers be? Let's say if we were to look at the capacities which are almost committed, like which will be completed irrespective of the. So what are your numbers? I mean,
in terms of numbers, particularly in the north and western region, it will be around say 15 million ton will be added in next say 18 to 24 months.
Okay.
That's capacity. And if we'll see across India, I'm not sure, but somewhere around 40 to 45 million ton will be added in say next 18 to 24 months period. In this period, which is already announced and work is already started on that projects.
Okay. So the same question to Mr. Tuteja about capacity, and also if you can give a sense that do the cement players have some kind of a flexibility that even with the projects which are actually under implementation, is there a possibility of them to slightly kind of elongate the completion schedule to ensure that the market doesn't get destabilized too much? So what are your perspective on the same?
Sure. So first of all, I think the industry players have not discarded their optimism about the long-term story. So these projects or capacities get set up for a long-term story, not for 1 or 2 quarters or 1 year of maybe muted growth. So those cycles will always be there. So I totally agree with Jigar that whatever projects you have already started, I think there's no point stopping. So those will definitely continue. So whatever capacity is committed till FY27, I think will come, irrespective of the volume growth happening on the demand side. And my take is, I think about Pan India, roughly about 160 million capacity should get added in FY25 to FY27, which should be about 7 to 8% CAGR growth. So we expect that demand growth also should be about 8 to 9%. So that will continue. And
Okay.
beyond that, of course, if the optimism doesn't come in reality, then you can phase out the new expansion, because your gestation period of any new project has multiple stages, your limestone auctions, land purchases, etc. So until you have started the construction activities, I think you can always delay the onset of the project. But once you have started, awarded the contracts and started the construction work, it doesn't make sense to stop the project. Then as fast as possible, you should complete it and then go full out to sell the capacity.
Okay. Mr. Saraogi, what's your option? What is your opinion about this? You are more or less in agreement with what Mr. Shah and Mr. Tuteja have to say about the capacity expansion. And also we would like to hear from you about the raw material availability. I mean, is limestone available for the kind of capex we are doing? And particularly in line of the proposed geographical spread. Obviously, there might be limestone, but it has to dovetail with the kind of geographical spread of the new capacities which are being planned. So if you could hear from you about your perspective on capacity expansion, and also maybe a little bit insight on the limestone and land availability for setting up these projects.
I broadly agree with Mr. Shah and Mr. Tuteja in terms of capacity expansion. The capacity, none of us here feel that weakness is structural in nature. Structurally, I don't think there's any issue insofar as the industry is concerned. So it's just a few temporary issues which will get evened out over the next 2 months. So as has been discussed, broadly the demand should the growth in demand should by and large meet the growth in capacity. So the utilization level for the industry are not expected to be affected by the expansion. So at this juncture, I would expect the expansion to continue as envisaged. Okay. And coming to the next question, yes, insofar as the raw material availability is concerned, that is becoming a challenge because in certain regions, for example, northern region, not that means the auctions are not happening. The auctions that are required for fresh capacity addition, I don't think enough auctions, limestone auctions are happening in certain regions like north, even in central region. I think except for south, where also I am not sure whether the auctions are happening or not, but in terms of reserve also, except for south, in the other regions, at some point of time, there will be an issue insofar as limestone reserves are concerned.
Okay.
Yeah.
So that's something we need to keep in mind, I suppose, while watching the industry as to how the raw material story pans out. Now, my next question is, I would like to now move towards the prices, because more than the volume, I mean, apart from the volumes, the other, big, negative this year really has been, prices have been soft and, operating margins have been under pressure. So I'd like to begin with Mr. Tuteja this time. So how do you see the price story? I mean, when do you see the pricing power coming back to the industry? At what stage? And how do you see the pricing story behave across the various regions, let's say south, east, central, north, and west? I mean, how do you see the price story coming out?
See, because the capacity utilization continues to be low, let's say about close to 67%. And bigger players are acquiring more capacity, and naturally they have to sell the capacities of these acquisitions. Definitely, the market capital competitive intensity is going to be very, very high. So I don't think that the pricing power should come back very soon until there's a more consolidation happens in next 1 to 2 years. Of course, in the second half, when the traction of demand comes, naturally there is some tendency to improve the prices, and that we expect should happen, but marginally only in the current year. So the major role will be, of course, to improve our internal efficiencies to be able to sustain your EBITDA margins. So pricing power will definitely be a challenge, and especially the east and south, where the utilization levels are lower than the rest of the regions, the pricing challenges will be more accentuated compared to the rest of the three regions.
So, Mr. Saraogi, you would also broadly agree with this, that pricing is going to be a challenge and South and East are going to be the more difficult markets in terms of pricing?
I can't comment about South, but yes, in the East, we have seen that pricing has been a bit of an issue, and I would say that is primarily because of the capacity overhang. But generally speaking, I would definitely expect some increase in the price with better demand environment. The margins that the industry has been earning in the past couple of quarters, I don't think those are the kind of margins which the industry would be happy with. So definitely the industry players, regardless of the size, they would like to increase their margin, given that the industry is also so capital intensive. So definitely once the demand picks, I would expect there will be an endeavor on part of all the players to increase the prices. Now, to what extent, that will be a question mark. It may not be very, very significant, but definitely, depending on the region, let's say between 4 to 6, 7%, that is something one would definitely expect.
Okay. Mr. Shah, how do you see the pricing story pan out, and particularly in the northern and western markets?
See, the price is again, it is closely linked with the subdued demand, okay, and lower capacity utilization. And that now the ray of hope is that the demand should improve in next 4 to 5 months, and that too we are expecting that price will also have a upward trend from now onwards. See, everyone, while on this call, everyone's believes that this current level, the industries, and that too particularly capital intensive industry, where the EBITDA margin is around 12 to 13% across industry for this financial year for 6 months basis. So this is not sustainable, and prices has to come up, has to go up. And now the question is that how soon? And honestly speaking, that answer is not available with any one of us. If it is possible, it will be from tomorrow onwards. If it is not possible, it will take another few months also, or few quarters also. However, my belief is that prices has to go up, and minimum 30 to 40 rupees per bag increase. That will give at least a respectable number for the industry, where we should at least end this financial year. Because we already seen that prices are down by around 7 to 8% year on year till date. And by 30 to 40 rupees increase, at least we'll have some respectable number for the industry. But prices has to go up, and that is closely linked with the demand and utilization.
Okay. Anything, Mr. Shah, you'd like to share on the cost side, because the other side of the picture really is the cost. I mean, how do you see the cost going forward? And if you can just touch upon what the industry is doing to try to, because we are aware that, things like green energy, trying to get more of railway versus road for the outward transport, a lot of things we hear about. So maybe you can share your perspective on that.
On a cost part, see, particularly the two main aspects for the industry, which is demand and price. These are not in anyone's control. So now what is left out and what is pointing is towards the what is influenceable factors like efficiency improvement as well as cost optimization. And that gives a responsibility for each or every company within the industry that let us look into the what is controllable aspect which we can influence. And accordingly, the same thing is started by majority of the company. And what is also the today's that title of this webinar also, that the short-term headwinds, which is in terms of the subdued demand and price, which is a long-term opportunity for the industry, because we have focused on our controllable factors, both the efficiencies and cost with the minute details. The major factor that which you already mentioned, that by way of the increasing the green energy power, with a couple of reasons. One is obviously that controlling the carbon emission, and the second is the real impact, which is the most important and required, is about the cost optimization also. So that is the factor that each and every company has started working, and they are on this journey to improve this power cost particularly. Then the other factors is about the raw materials mix also. Not only the cost, but the mix and different types of raw materials which can be used while in the grinding of the cement, as well as in the raw mill for the clinker also. So, and the third one is about the fuel cost, which is by way of increasing the alternate fuels. So these all the parameters I touched upon. This is on the efficiencies and variable nature of part. Not only this, but also the fixed cost optimization, various overheads. That is also looked with the minor details. So these are the long-term opportunities which gave to this industry particularly. And in past, we have witnessed that many other industries, when we see such kind of headwinds, when the factors like price and demand both are out of control, then this is which is controllable is purely a cost, and that gives a long-term opportunities. And we have witnessed also. However, unfortunately, the impact of price is such much extent that the cost reduction is not compensate the entire part, and that helps to partly mitigate the risk, but not fully. But
No, I can, yeah, I can understand that.
Sustainable opportunity for the industry.
So, Mrs. Saraogi, anything you would like to share with us on the cost side? What are the things that the industry is looking at to try to optimize the cost?
Yeah, so given the macro scenario, everyone is trying to bring down the cost, but the Indian cement industry is already at a pretty high level in terms of the parameters efficiencies are concerned. For example, fuel efficiency and all, it is one of the best in global terms. So there's limited room really. So what the industry is doing, it is aggressively adopting the green energy adoption. So whether on power front and utilization of electrical vehicles. So whatever means are available to, and for example, AFR, what Mr. Jigar spoke about. So whatever means are available to bring down the cost, the industry is pursuing that aggressively. But those can have a limited effect insofar as the profit margins are concerned. Yeah.
Okay. Mr. Tuteja, anything that you would like to share, anything different or new you would like to share with us on the cost side?
Yeah, I'd like to remind us about this COVID year 21, when everybody was seized of a crisis, and that crisis, everybody tightened their belt, and we reported the best ever profitability. So now is the time that everybody has to tighten their belt, not only on the VC side or the fixed cost side, but also in the area of logistic as well as sales, how to improve your discount schemes, how to ensure that your logistic cost comes down. So this is the time to tighten your entire ship so that these benefits will last for next 5-10 years. When the prices improve, your margins will be really, really healthy.
So now I move to the last, set of questions. Basically, one of the things, major trend in the industry, we have seen a fair amount of consolidation in the industry over the last 3-4 years. We have seen a lot of, M&A activities. So, Mr. Saraogi, my question to you is, do you see the, trend of M&As to continue? Do we still see some fairly significant M&A activities going forward? And which are the regions where you think, these M&A activities would be seen most prominently? Which regions of India?
I certainly expect this trend to continue because apart from the growth ambition, one major factor which is, in my view, driving the M&A is the limestone, availability of limestone, as we discussed. That is becoming a bit of challenge because of the low availability of reserves in several parts of the country. So through this M&A, actually, organization gets an opportunity to get limestone reserves. So that is a big factor when it comes to M&A. So that should continue to drive M&A, this particular aspect, apart from obviously the capacity. So more than the capacity, it is a limestone reserve in my view, which is an equally important factor in driving an M&A, and that will continue to do so. And in terms of region, I think because South has got still has got many smaller players, so that should be an epicenter. Most of the M&A, majority of them should take place in South. And in other regions also, the smaller players may find it lucrative to exit through this route. Yeah.
Okay, thank you. Mr. Shah, what's your opinion about M&A landscape in the country? You expect the pace of M&A activities to continue, and again, which regions will be the most likely to see the most capacities changing hands?
See, on M&A part, if you'll see the picture of last, say, 7-8 years. So if I'll see the data based on, say, 2016 onwards, so almost, say, rounding off to around 200 million ton worth of capacities has already changed hands. Tuteja Sahab has acquired many things, Saraogi sir has acquired. So this, in total, that 2016 to 24, this last 8-9 years, that almost 200 million ton capacities has changed hands. The traction is increased, particularly when larger player in last 3 years when acquired the major capacities, say around out of 200 million, the 125 million is last 3 years. Okay. So that the traction has come in the industry, and when we saw the many of the small players, and when they realized that the main thing that for the acquisition is that small player realized that to grow big, it is required to be a national player or a larger capacities, which is perhaps not possible for the small players, and M&A activities has started. This will continue for some time. And what Saraogi sir has mentioned that it is largely for the regions where the smaller players are there, particularly. And there is no surprise that any larger player can also be acquired. But also this attraction will be particularly for the players where the small players are more. And that too particularly South and followed by the Central.
Okay. Mr. Tuteja, can I have your perspective on the M&A? And also, one related question, because in several, a lot of these limestone mines leases will also be coming into the play over the next maybe 5 years or so. So how do you see, the M&A activities and what impact, the expiry of the leases, what impact it could have on the overall, market structure in the country?
So first of all, I'll endorse the views expressed by Mr. Saraogi and Jigar that this Monday is not yet over, and this will continue. Rather, may accentuate also. And because these things depend on the synergies which the acquirer can get from the other company. And these will change from company to company and region to region. So I'll not stick that only South could be the major arena. This could happen across all regions in the country. That play can be there. And limestone is one of the area. And second is the logistic efficiencies or other efficiencies which you get into total cost of delivery, how you can optimize the acquisition of any plant. So these interplay will determine what kind of offer a big player can give for anybody else to acquire. And coming to the limestone auctions, definitely the cost of production will go up because many of these re-auctions will happen at a price, at a premium. So those premiums will definitely increase the cost structure of the industry and will have to be passed on to the customers. But it is interesting that how the equations will develop, whom are going to compete and how we are going to balance that.
Okay, great. So broadly, if I can, the key takeaways that I see from a webinar today is that yes, short term, there might be some concerns on the demand. There's a mixed view on that. But long term, the growth story for the cement in terms of volume growth is very much intact. Prices will, come under, will remain under pressure for some time, as the large new capacities are going to stabilize over a period of time. But at the same time, the industry is looking at optimizing the cost structure through both energy as well as logistic means, which I think would support the industry partly in the short term till the prices start correcting themselves. Capacities will also grow as the demand grows, and we also see M&A activities continuing and greater level of consolidation in the market. That seems to be the key message that I'm getting from the whole panel discussion as well as the presentation that we had. Now, I'd like to open it to the audience if they have some questions. And Ravleen, if you have any questions, do feel free to ask, and maybe you can take up the question and answers from the audience.
Yeah, sure, Sabu, thank you. We have a few questions. Maybe I direct this one to Mr. Tuteja. There's a participant who's asking on the alternative raw materials to cut down the cost and from a sustainability perspective in the environmental growth. So Mr. Jeevan Jain is asking this. He would like to understand, how much cost cutting is possible or how much saving per EBITDA per ton is possible generally on the at the industry level.
The biggest advantage which can come is using the alternative fuels. So more than the raw material, of course, raw material, definitely everybody is trying to increase the blended ratio. But also on the alternative fuel side, there's a opportunity to reduce the fossil fuel and increasing the alternative fuel consumption. So both of these, I think, can bring down the cost of operation by about 100 to 200 rupees per ton, depending on at what stage of blending or at what stage of usage of alternate fuels you are.
Okay, so close to a saving of close to 100 to 200 per ton is the saving that the players can still juice out more.
By increasing your alternate fuels as well as alternate materials.
Sure. Thank you. And Mr. Shah, maybe I direct this to you. One of our participants would like to understand that in case prices are not expected to improve materially soon, what levels of operating profitability would you believe that the sector is likely to achieve? And also from a medium-term perspective, given the replacement cost of the integrated unit put together, what is the earning that you should have to have a normal ROCE in the industry?
So first question is about the anticipated EBITDA or EBITDA margin for this financial year. So that based on the even the presentation also what we saw that fully agreed that it will be around 800 to 850 rupees for the full financial year. Looks like based on the current thing. However, in case of major price increase for the next 4 months, it will have a little upward price also. But on the lower end also, it is around 800 to 850 rupees per ton kind of EBITDA can be seen across the industry for this particular year. And regarding the targeted ROC to achieve, at least the industry should aim for at least 20% EBITDA margin. And in that thing, around 1200 rupees kind of EBITDA margin will give a decent ROC, which is historically enjoyed by the industry.
Okay. Our next question is linked to this, and maybe Mr. Saraogi, I request you to take this up. Here, what the participant is requesting is, he would like to understand that close to 1200 million per ton. I mean, though there were 2 fiscal years post-COVID when we, like you all just spoke about it, then the industry saw very good EBITDA per ton or the contribution margins coming, but those were not sustainable. So do we see the industry likely to go back on a trend, with 1200 to 1300 per ton? Also, given the changes that will happen in the mineral rights some years down the line, do you think that these levels are attainable from an average perspective?
Well, I would definitely expect those levels to come in the next few years, definitely, because given the capital intensity of the industry, why would an investor put money if he is not getting adequate returns? So definitely, I would expect those levels to be achieved in the short term because of the demand subduedness, etc., and maybe there's some frenzy for capacity addition, but I expect all these to get normalized over the next couple of years, and definitely all the industry players would aspire to be at those levels of 1200 to 1300.
Okay. Thank you. Mr. Tuteja, this I would request you to please take it up. Since we all understand, the mineral rights changes were there. So post this FY30, when, certain players would have the leasing rights expire, do we see the competition intensity further increasing from there on? Because we do expect the raw material cost would significantly step up for the industry, though we are doing a lot of efficiency plans today, like majority of the big players, including the medium-sized players, have been guiding the investor community and the industry at large. But then, do we see the cost curve, still going north post FY30?
Yes, and to cover that, I think there will be some M&A activity happening so that people can minimize this competition.
Okay. Great. I think thank you all, and that will be the last question because the other questions are primarily what we've already covered while Mr. Mazumdar was moderating the panel. So over to you, Mamta. You please take it up.
Thank you, Sabyasachi and Ravleen, for moderating the session, and Yash and Bhoomika for your presentation. Once again, thanking all our guest speakers for the insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedbacks, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.